Hey everybody, this is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, May 30th, 2026. Hey, I hope you're doing well. Hope you had a good trading week. I hope you are having a nice weekend, and I appreciate you coming to my weekend review podcast. I hope you are going to find something of value in it today. So the format for today's podcast is first of all, we're going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to take a look at all the trades that I made last week, all the positions that I'm still in, the entries that I just made, new entries, exits that I got out of where I hit my stops. But I have a lot of different positions this week that I'm going to show you, different strategies. So I think it's going to be a good learning experience today if you are interested in that kind of stuff. And so I will definitely show you when I entered the trade, why I entered the trades, what were the signals, what were the confluence of signals that why I entered the trade, how I position sized, how I place my emergency stop, how I place my end of bar stop, how I take partial profits, the market moves in the direction that I want it to, what happens when I get to trailing stop level, and then ultimately how I exit the trade if it gets to over bought levels. So when I enter the trade, why I enter trade, and then most importantly, how I am going to manage the trades going forward. After that, we're going to talk a little bit about trader psychology. Always the most important skill in trading is the ability to create a plan and then to follow the plan. There's a lot of plans out there. There's a lot of strategies out there, a lot of good ones. And if you follow them in the long run, they usually work. But if you don't follow it, it's not going to work for you. So I'm going to talk about the importance of creating that plan and then following that plan. After that, I have gone down through my watch list last night, Friday night. I go down through every ticker that I have and I look for potential trades for the next week. I look for confluences, combinations of important key levels. Now I'm looking for a rejection of those levels so that I can structure the trade. So I believe I have 8 potential trades for next week. And I've had a lot of people say, Greg, really like to see how you set these trades up and follow them and see. And if I'm doing my job right, I'm not going to win on be profitable on every single position. But the key is in professional trading, look for rejections of key levels. You can't control anything. If you're wrong, you're going to be wrong. But if you structure everything right, hopefully you're going to be wrong small, and then you have the ability for outsized gains every once in a while, and you need those in trading. So I'll go through all the different positions, or I'm sorry, all the different candidates for next week that I'm looking for and tell you exactly what I'm looking for. Levels to be rejected, and then if they are rejected, then I will potentially take the trade. So if you find anything that's helpful today in this podcast, I really would appreciate it if you could hit the thumbs up button. Totally easy, totally free, just lets YouTube know that there's some valuable content here, and so they can have the algorithm get it out to more people. And I've had a lot of people lately send me messages, Greg, thanks, really finding it helpful, really finding it educational. So anyway, really happy to see that. So let's go ahead, get the U.S. legal disclaimer out of the way, and then we'll get started with the current positions. Hang tight.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right, thanks for holding through that with me, and let's get started with current positions. The first position that I entered here on the 19th of May is CCL, which is Carnival. This has been a really great trade. Bought it here on the 19th at 23.88. Obviously, you can see it's moved up really strongly. So first of all, let's talk about why I entered this trade. This trade is a rejection of the bottom of the order block. The order block is this green box, and this green box was formed in the past. And the reason that I entered this trade was because on this day, on the 19th, during the day, we poked our head just slightly underneath that order block and then closed back in the order block. That's called a rejection of the order block. And order block, you've heard of order blocks before, but really what how I like to think of order blocks are smart money areas. So first of all, let's talk about what an order block is and when it was formed. So if we go back to here, this on the 30th of March is the order block. So in order for an order block to have formed, we need four things to happen in the past. First of all, we need to have a swing low. A swing low is simply a low that has a higher low to the left and a higher low to the right. So this here on the 24th is a swing low. After the swing low, we need a swing high. It has to be followed by a swing high. A swing high is just the opposite. It has a lower high to the left and a lower high to the right. So we have a swing low here. We have a swing high here. Now, the third thing we need is another swing low that's lower than the first swing low. And you can see here, this is a swing low because it has a higher low to the left and a higher low to the right. And this swing low is lower than the first swing low. So let's recap. Swing low, followed by swing high, followed by a lower swing low. Now, when those three things are in place, we need to reference back to the high of the first swing high. Remember, swing low, swing high, lower swing low. Now we have to reference back to the swing high. If in the future, when you have the swing low, swing high, lower swing low in place, then in the future, if the price moves up and goes above that first swing high, now you have what is called structure change. And so in other words, the way that I look at this is now we are in an uptrend. And as soon as that first swing high is taken out, now we can define the order block. The order block is the high and the low of the lowest closing bar prior to market structure change. So one more time, swing low, swing high, lower swing low, market structure change. On this day here, this becomes an order block because we change market structure by taking out that first swing high. So I am going to highlight the high and the low of the lowest closing bar prior to the market structure change. Now you have your order block. Now this is smart money. And so I bring this order block into the future. And just to kind of highlight this, when you go here on the 17th, way up here, when you look back at that order block, I think it's fair to say that smart money was buying in this area. In hindsight, right? When you're way up here and you look back to where that order block was formed, clearly smart money was buying here because we went all the way up here. So the idea is clearly this was smart money in this case. And so we want to bring the order block into the future. And if the price comes back down to that smart money area, it doesn't mean that because it was smart money here that it has to be smart money in the future. But in over 30 years of experience, more often than not, it is smart money again. So that's the idea. But kind of a broader picture, there's an old saying, buy dips in an uptrend. Well, what's great about this structure is it tells you when you go into an uptrend, swing low, swing high, lower swing low, market structure change. Here we go into an uptrend and it tells us exactly the area to buy the dip. All right, so that's why this order block was formed. I brought the order block into the future. And with order blocks, there's many different ways you can enter an order block. You can enter an order block with a high of the order block. Like you see the day before, this was a rejection of the high of the order block because the day before we closed in, we closed above. That's a rejection of the high of the order block. I purchase with the rejection of the low of the order block. I don't usually buy rejections of the high of the order block. I like to buy rejections of the bottom of the order block, or if you have a major moving average or some other key level inside the order block. All right. So, but on this particular trade, I entered because it rejected the low of the order block. So I entered here at 23.88. So, okay, I see my entry. First thing I have to decide is how many shares am I going to buy? It's the most important decision you'll make in your trade is how many shares you're going to buy. If you buy too many shares, it can be your rocky road. If you don't buy enough shares, it really doesn't mean anything, right? So let me share with you the formula that I use, and it's very simple, and it incorporates two things. How much is in my trading account, number one, and number two, what is the value of the volatility of the market? Sometimes the market's more volatile than others. If the market is the way that this formula works, is that the market is very volatile, this number, the 2 ATR, is going to be much larger, and therefore I'm going to buy fewer shares. If there's less volatility, this number will be smaller, and I'll buy more shares. All right. So the formula is 1% of my total trading account. Let's just say I have a $200,000 trading account. 1% of that is $2,000. If you have a $50,000 trading account, 1% is 500. If you have $1 million trading account, 1% is 10,000. So it doesn't matter what the value is. It's just I personally use 1%. I know people that use 2%, 3%. Sure, they're going to make more money, but there's more risk. I like 1%. So let's say I have a $200,000 trading account times 1%, $2,000. I simply divide this. This is my maximum allowed loss that I'm allowing to have on this trade is 1% of my account, regardless of the account value. So 1% of 200,000 is $2,000 divided by the value of the 2 ATR. This tells me to buy 847 shares. All right. So my maximum allowed loss on this account is 1%, $2,000 divided by the value of the 2 ATR. It shows me exactly what to buy based on how much I have and what the current market volatility is. If the market volatility was much higher, I would buy fewer shares. But at the moment that I bought, this is how many I bought. Okay, so now I know how many shares I'm going to buy, 847. We have a rejection at the bottom of the order block. I buy 847 shares. Now, so I entered 23.88. The first thing that I do is I take my entry price minus the value of the 2 ATR that I just did the math on. And I place my emergency stop exactly the distance of 2 ATRs below me. So in the future, if I have 47 shares and it goes down $2.36, I have lost $2,000, right? So I know exactly what my worst case scenario is going to be. Now, the good news is that this only happens about 5% of the time that I'm going to hit my emergency stop. Or in other words, it only happens about 5% of the time that when I enter, it's going to move down the value of 2 ATRs. The other 95% of the time, if I have a losing trade, it is going to be because of my end of bar stop, not because of my emergency stop. And when I take a rejection at the bottom of the order block, my end bar stop is simply a close below the bottom of the order block. And you can see my entry is very close to that. So that's how I set things up where I know exactly what my worst case scenario is, but my worst case scenario is only going to happen 5% of the time. The other 95%, my end bar stock's going to come into play, and my entry price is always going to be much closer to that end of bar stop than my emergency stop. Make sense? Okay, so we have a rejection of the bottom of the order block. That was my entry. I position size correctly. I placed my emergency stop 2 ATRs below my end bar stop. I know the close below the low of the order block. And I do want to mention at this point, I base my end bar stops on the closing price of the day. During the day, it doesn't matter, but I base it on the closing price. So if just like the very next day, you can see during the day we were lower, but I didn't get out because I wait for the end of the bar stop or the end of the day. There is one exception, and that is your emergency stop. If at any point it touches my emergency stop, whether that's in the morning, middle of the day, end of the day, I immediately get out, because if we've done the math, if it goes down to the emergency stop, I have lost 1% of my account, and I'm not going to wait till the end of the day because it could get worse. Okay. So emergency stop is any time during the day. End of bar stop is waiting for a close of the day. All right. So after I enter, I know where my emergency stop is. I know where my end of bar stop is. The next thing I do is I take my entry price and I add the value of the 1.5 ATR, right? Today, it's $1.77. So I take my entry price plus whatever the value of the 1.5 is, and I place an orange line. This is my trailing stop level. So in trading, if you take a trade and it starts to move a certain amount, a significant amount from your entry, you've probably heard now you want to tighten up your stops. And that is absolutely true, because once it's moved nicely in your direction, you don't want to give it all back, right? And so some people actually move up their stops. But the way that I do it is that after I enter, if we get to my trailing stop level, doesn't mean I take any action. It just means now, in the future, if I have a close below a previous bar's low after reaching trailing stop level, I'm going to exit half of however many shares I have at the moment. And that has the effect of, because I'm selling half, it has the effect of moving all my stops up. And I prefer to do it that way. All right. So now everything we've talked about so far, the emergency stop, the end of bar stop, getting into trailing stop mode and selling half if you have a close below previous bar's low, these are all considered defensive moves. In other words, if the market moves against me in some fashion, I have to take some kind of action defensively. But I also like to play offense in my trading, not just defense. And the way that I play offense is I take a portion of my position off each day if the market moves a certain amount from the previous bar's close. So I'm currently in this position. Let me show you exactly how I'm going to do this for Monday. It's very simple. All I do is I take my closing price. Right now, closing price on CCL is 28.06. And now I look to the value of the 0.45 ATR. The value of the 0.45 ATR at the moment is 53 cents. So I take my closing price on every single day, this changes. Closing price plus the value of the 0.45 is 28.06 plus 53. My first profit target for Monday is 28.59. So let's just mark these up so you can see these. 28.59 is my first profit target. Now I place 3 profit targets each day. I showed you how to place the first profit target, closing price plus the value of 0.45. My first profit target is 28.59. To get my second profit target, I take my first profit target, 28.59, and I add the value of the 0.45 to it again, 29.12. Is my second profit target. And to get my third profit target, I just take my second profit target, 29.12, again, plus the 0.45 ATR. My third profit target for Monday is 29.65. Okay, so there are my those are my 3 profit targets for Monday. So the question is, how much profit do I take off? It's very simple. I place my 3 profit targets every single day, and in my trading platform, I place a limit order, 3 limit orders to take off 10% of however many shares I go into the day with. If I go into Monday with 100 shares, 10% is 10 shares. 10 here, 10 here, and 10 here. If I go into the day with 90 shares, I take off 9, 9, and 9. So if I have a nice day, a decent day, maybe I hit one profit target. Okay, great. I lock in some profit, reduce my position size, reduce my overall risk. By reducing every time you reduce your position size, obviously you have fewer and fewer shares, and there's less stress on the trade, and you're more likely to follow your profit. All right. If it goes down, then I don't hit any profit targets. And then I have to recalculate for the next day based upon a lower closing bar. So the nice thing about taking profit targets, there's a lot of advantages, but multiple advantages. But what I really like is I'm selling into strength. And when the market gives me something, I want to take something, right? Not everything, but something. So I like in sports, it's very important you play offense and defense in trading. 100% I believe the same thing. You have to have your defenses in place, your emergency stop, your end of bar stop, going into trailing stop mode, taking half of the closes below previous bars low. But those are all defensive. I need to have a component of my trading where I take partial profits into strength. All right, so okay, so those are kind of the basics. And going forward, I won't go into all of those specifically like I did in this particular trade. But now that I've kind of given you the basics, let's do the trade. Okay, I entered here on the 19th of May at 23.88. Why? Because we rejected the bottom of a previous order block, or in other words, a smart money area. I entered at 23.88. I placed my emergency stop 2 ATRs below. My end of bar stop is simply a close below the order block. My entry is very close to that, making my risk to reward good. I placed my 1.5 ATR trailing stop level above, and here we go. The next day it opened a little higher, went down. I thought, uh-oh, but then reversed much, much higher. I hit multiple profit targets into that day. And on the very next day, on the very same day, the next day after I entered, it hit my trailing stop mode. Doesn't mean I do anything. It just means now in the future, if I have a close below previous bars low, I'm going to get out of half. Next day, didn't do much, but did not close below the previous bar's low. Next day closed down a little bit, but not below the previous bar's low. Next day gapped up. I sold. I hit a profit target into that strength. Next day up really big, hit multiple profit targets into that strength. And ever since then, the last 3 days has pretty much moved sideways. So no profit targets on Monday or on Friday, excuse me. But I am in trailing stop mode. For instance, if Monday we close below Friday's low, I would exit half. So this trade is doing very, very well. And the remaining shares I have up 14.97%. But this is a very good example, everyone, of looking for a rejection of a key level, position sizing based upon the volatility in your account size, knowing that you have your worst case scenario already planned out, having a good starting risk to reward ratio, meaning that you're very close to where you're getting out if you're wrong, but having the potential for a big gain. And that's exactly what happened. So current position or remaining shares on Carnival up 14.97%. Dash. All right. So Dash, you can see I have another order block here. The majority of my trades involve order blocks. I would say 90% of them because they're such a good indicator. So I entered Dash here on the 14th of May at 153.70. So there is an order block. Let's go back and look. Swing low, swing high, lower swing low. Market structure change. I define the order block as the high and low, the lowest closing bar, and that's why I brought the smart money area into the future. Now, with a lot of my order block trades, like I just showed you on CCL, rejection of the bottom of the order block, or maybe an under 30, over 30 in the middle, or a rejection of a moving average that lives inside the order block. In this case, I didn't have any of those, but there are times where I will place my own level or my own line in the sand in the order block. And that line in the sand is this green line, 150, 140. So why did I place this here? Well, it certainly has something to do that happened in the past. So let's go back and look. Okay, the reason I put in the 154 level is based upon these three bars. These three bars are called a V2. A V2 consists of three bars, bar 1, 2, and 3. And for a V2 to occur, bar 2 has to go below the low of bar 1, which it did, and bar 3 has to close above the close of bar 1, which it did. So this is a V2 entry signal. You can see it worked out pretty well. But the key level here, the 150, 140 level, why did I put it right here? Well, because I know that on a V1 or a V2, the inherent support of the V1 or a V2 is halfway of the number 2 bar. So this 150, 140 level is halfway of the V2 bar. By the way, if you want to learn more about V1s and V2s, go to my YouTube channel, look up V1s, V2s. I have a good video in there that shows all the rules and everything about V1s and V2s. But the key point here is when you have a V2, the inherent support level of V2 is halfway of the washout bar. So being that this particular order block did not have any other key levels in it, I made my own. And so you can see we moved down, we moved down, we moved down. This day, the day before I entered, it closed below that key level of 144, or I'm sorry, 150, 140. But the next day we closed back above it. So that is a rejection of that key level, and that key level is also my end of bar stop. So I entered here on the 14th of May at 153.70. I position sized based upon my account value and the value of the 2 ATR. I placed my emergency stop down here, 2 ATRs, so if it got down there, I'd lose 1% of my account. My end of bar stop is simply a close below that key level that I put in at 151.40. So I have a good starting risk to reward. I placed my trailing stop level, as always, 1.5 ATRs above, and here we go with the trade. Next day, up nicely, hit a profit target. Next day, up nicely, hit a profit target, sold into that strength. Next day down, no profit targets whatsoever. Next day, there was a bit of drama in the morning, but then a reversal by the end of the day where I did hit another profit target. Next day, nothing. Next day did hit a profit target near the top, and I also got into trailing stop mode. You can see it touched my trailing stop mode. Now I'm in trailing stop mode. The next day, we have our first close below a previous bar's low after reaching trailing stop level. What did I do? I took off half of the position. And the half of the position that I took off was essentially break even. You can see there, just a little bit of a gain, but essentially break even. But keep in mind, is the trade break even at the moment? No, because I took profits here, and I took profits here, and I took profits here, and I took profits here. So overall, there is profit in this trade. The next day we went up, hit a profit target. Next day, kind of a nothing burger. And then Friday, near the high, I also took off a profit target as well. So big fan of profit targets. The remaining shares that I have on this particular trade doing pretty good, decent, up 3.51%. GDX. All right, GDX has been a really good trade. I entered GDX here on the 21st of May at 86.10. You can see there's an order block here. On this particular entry, kind of interesting, two major things happen. The first is that we had an intraday rejection of the 200-day moving average. This is the black line. During the day, we were below it, but then we closed back above it. That is a rejection of a 200. That is a deep dip buy signal by itself. But in addition to that, not only did we reject the 200-day moving average, we also rejected the bottom of the order block. During the morning, we opened up lower. but then we close back in. So those are two signals, two primary signals, rejection of the 200-day moving average and a rejection of the bottom of the order block. So I entered here at 86.10. I position size correctly. I placed my emergency stop as always, 2 ATRs below. My end of bar stop on this trade is simply a close below the 200-day moving average. And then I placed my trailing stop level 1.5 ATRs above. Next day, didn't do much, barely closed over the 200-day moving average by a penny or two. Had it closed under, I would have gotten out of the trade for a very, very small loss, but it did manage to close above. It kept me in the trade. Next day, we have a nice move up. I did take some profit targets into that strength. Then the next day, we come back down, barely closed above the 200. Had it closed under, I would have gotten out of the trade. The next morning opens lower, reverses up strongly, did take a profit target, did hit a profit target. And then on Friday, we moved up again, where I did take some profits into that strength. So the remaining shares that I have on GDX doing nice, up 3.79%. And again, this is a combination of a deep dip buy signal, which is a rejection of the 200-day moving average, and a rejection of the order block. Both primary signals, two primary signals together with a good risk to reward ratio. That is why I took the trade. Going forward, if we have another day up, then I'll get into trailing stop mode, which is always a nice feeling because then I have a rule. If I have a close below previous bar's low, then I get out of half of the remaining shares that I have. So we'll see, but the remaining shares up 3.79%. Silver. All right, silver, this particular trade strategy is a little bit different than what I've shown you so far. There is one strategy where I do not take partial profits. I do not go into trailing stop mode. Essentially, this is a longer term trade. So this trade I've been in quite a long time, actually. This trade I got into here on the 18th of February at 69.80. So usually I'm very active with my trades, taking partial profits, all that. But I do like to have a little diversification in some of my positions that are essentially just longer term trades that I really don't have to do much with. And this is exactly one of those. And so I entered SLV here on the 18th of February at 69.80 for two reasons. The first reason is we rejected the high of the order block, the green box. You can see the previous day we closed in it. The next day we closed above it. That is a rejection of the high of the order block. In addition to that, you can see the bar that's highlighted in blue. This is called an abandoned baby. Strange name, I know, but abandoned baby takes place. Abandoned baby consists of three bars. And so the blue bar here on the 17th, you can see the previous day on the 16th, we gapped down. So overnight, there was bearish sentiment. That's why we gapped down. But the very next day after the gap down, we gap up. So whenever you have a very sudden and decisive shift in sentiment, usually in the future, you're going to see those prices higher. And so that's why it's called an abandoned baby. We gapped down, immediately gapped up, kind of leaving this baby by itself, hence the name abandoned baby. All right, so it's a very strong signal, and in addition to, it rejected the high of the order block. So on this particular trade, and I have another one actually that hit it, that I exited on Friday. On this particular trade, I make it very simple. I take my entry price, I place my 2 ATR stop below. If it gets there, how much have I lost? 1% of my account. That's correct. But on the upside, instead of a 2 on the downside, 2 ATR stop loss, I put a 4 ATR profit target above, and then I just let this trade go. I'm either going to lose 1% of my account, or I'm going to make 2% of my account, for sure. I mean, eventually, I think you'd agree, eventually we're either going to go down to here, or at some point we'll get up there. So I don't have to maintain this trade a lot. I just kind of watch it. But the important part is that I got in with a confluence of signal. We had an abandoned baby plus a rejection of the high of the order block. I placed a 2 ATR stop loss below me and a 4 ATR profit target above me. So if I'm right, I'm going to make twice as much as if I'm wrong. And the nice thing about these trades is that I am right more times than I'm wrong. So more times than not, I'm going to make twice of what I'm risking. And that's the key. So you can see once I entered the trade, it started off really great and it's been all over the place. Then we came down. I was underwater on the trade. Then I was in the money on the trade. And then below, and then a couple of weeks ago, really doing well. We're back down again. So anyway, it's fine. This particular trade at the moment is underwater, meaning it is a loss of 2.22%. But I don't do anything with it unless it comes down. It's my emergency stop, in which case I lose 1%, or I have the 4 ATR profit target above. All right, Lockheed Martin. You see the green box, so you know it is order block related. Been in this trade for a while. I entered Lockheed Martin on the 24th of April at 512.08. Why did I enter? Well, we have an order block, green box. On this particular day, we rejected the 250-day moving average. This is the key deep dip buy moving average. This is the purple line, meaning during the day we went under it, excuse me, and then we closed back above it. So I entered here 512.08. I position size correctly. I placed my emergency stop, as always, 2 ATRs below. My end of bar stop is simply a close below this purple line. That's it. And my entry is very close to that purple line to begin with, so it's a good starting risk to reward ratio. I also placed my trailing stop level 1.5 ATRs above, and let's go through the trade. The next day started off fine at the top. I actually hit a profit target at a profitable level, so I took a little off. The next day came back down, touched the 250 but closed above it, kept me in the trade. Next day pretty significantly below the 250 but barely closed above, keeping me in the trade. The next day had a profit target here, had a profit target, and then we had 2 more days where we're testing the, oh my gosh, wait. Golly. You know what, everybody? I was looking at this from a previous entry. The entry was here. My apologies. The entry was here with a close under, close over the 250. That was from a previous trade. I am sorry. I didn't thought I was in that trade one time. I'm sorry. I didn't realize that. So the entry was here on the 11th. That was a previous trade. Entry was here on the 11th, 512.08. I placed the emergency stop 2 ATRs below, and my end of bar stop is a close below the 250. There we go. And then trailing stop level here. Okay, that was confusing because I've been in LMT twice. All right, start over. Entry price was here on the 11th at 512.08. So position size, 2 ATR stop below, end of bar stop close below the 250-day moving average. Trailing stop level up here, 234. Next day up, took profits into that. Few days sideways. Here we have a nice big move up, took profit targets. Sideways, profit target here. And then here on the 22nd, got to trailing stop level, okay? We gapped open, came down. Thursday had a nice big move up, and then Friday we had a close below a previous bar's low after reaching trailing stop level. What do? I took off half of the remaining shares for a gain of 3.47%. So, you know, the nice thing about taking half of your position off is that it's kind of the only win-win situation in trading. If it continues to go up, I still have half. If it goes down, I already sold half. So I'm a big fan of taking off half of your position if it gets to trailing stop level. So yeah, sorry about that. That was a previous trade. I just left the entry signals there. And I noticed that because This particular, see, this was an original entry I had, but then do you see how here on the 8th it closed below the 250? So I got in here, got out here for a small loss, but I just left those there. But the new signal came on the very next day when it closed above the 250. So remaining shares on Lockheed Martin doing nice, up 3.47%. RBLX. All right. Oh, yeah, I remember this trade. Okay, so I entered RBLX here at 42.82 on the 15th of May. So why did I enter here? Well, there's a couple reasons. On this particular day, on the 13th, we were at a 29 RSI. And so from a deep dip buy perspective, if it goes under the 29 RSI and then over the 29 RSI, that's an entry signal. And that happened the very next day. On the very next day, we closed above the 30 RSI. We also closed above the negative third ATR channel, and also we're above the order block. So the actual trade was on the 14th of May. Now, I took another trade on the 14th of May, so I did not take this trade. However, I did take the trade here the next day at a lower price. And so if I would have been in the trade on the 14th and then the next day is down, would I still be in the trade if I took it the previous day? Yes, of course, because it didn't close below the 30 RSI. That was the reason I took the trade, right? So is it okay for me to enter a trade if I didn't take it the previous day? And for me, my answer is 100% yes, because if I took it the previous day, I'd still be in it. So why not get into the trade if I'm getting a better price on a trade that is still valid? Okay, so put my entry there. I don't know why I got deleted out there. Okay, so the entry started here on the 15th. The next day, took right off, hit multiple profit targets. Really nice, really good trade. The next day, we reversed back down, but no harm, no foul. Next day, up, took some profit targets into that strength. Next day, profit targets into that strength. Next day, profit targets into that strength. And on this particular day, also got to trailing stop mode. The next day was our first close below a previous bar's low after reaching trailing stop level. What did I have to do? I had to take off half of my position and locked in a gain of 6.78%. Next day was up a little, then reversed. Thursday up nicely, hit a profit target into that. So on the 26th, I took half of the shares off for a gain of 6.78%, and the remaining shares that I have are up 9.12% on this particular move. So really nice trade there. Gold. All right. Gold's been a nice trade. We have an order block, a green order block from the past. And in addition, the reason that I took this trade was two reasons, but let me explain. Do you see this trend line that I have here? This is called a megaphone trend line. A megaphone trend line happens when you have a swing low, and then you look out into the future and you have other swing lows that are lower. If you connect this swing low to the next swing low, to the next swing low in this case, and you draw the trend line out into the future, so here basically we have one touch, here we have the second touch. When you get to if in the future you go down enough to get to the slope of that line and to make a third touch on that megaphone trend line, very often you will have bounces right there. And that's exactly why I took the trade, because on the 27th, we did reject the megaphone trend line. It was the third touch of the megaphone trend line. We opened lower, reversed back above it. In addition to that, a secondary signal is you see this thicker gray line here. This is called the negative third Keltner channel, or the negative third ATR. 92% of prices, when they get to the negative third ATR channel, stop going down, or bounce. And so that's a good thing to know. So the primary signal in this was that I rejected the megaphone trend line. The secondary signal was that we rejected the negative third ATR channel. Both of these are during the day, price opened below both and then closed back above. Now, would I have taken this trade if it was not in an order block? No, I would not have. So I entered here 408.48, placed my emergency stop 2 ATRs below. My end of bar stop is simply a close below this trend line. And then of course I placed my trailing stop level above. Next day, started off great, hit profit targets into Thursday, Friday up again, also hit profit targets, and now I'm in trailing stop mode. So now in the future, if I have a close below any previous bar's low, I will exit half. And this particular trade doing quite well, up 2.03% in 2 days, so not too bad on gold. Netflix. All right, I took Netflix on Thursday. I took Netflix here at 528. And let's go back and take a look why. Well, you have a green box here. Green box means it is an order block. And let's find it. Swing low, swing high, lower swing low, market structure change. The market structure change defines the order block, the high and the lowest closing bar prior to market structure change. I highlight it, high and low, bring it into the future. Now I'm waiting for the price to come back down into the order block and reject a key level. Well, there are no moving averages in here. So I created my own level here at $86 even. Why this level? This level is a halfway of a V2 in the past. Bar 1, bar 2, bar 3. 2 goes under bar 1's low. 3 closes above bar 1's close. Remember, the inherent support level on a V1 or a V2 is halfway of the second bar between the high and the low of the second bar. There it is. I took the entry at 86.40 on the 28th, Thursday. Why? Because we rejected that key level of 86. So I entered 86.40. I position size. I placed my emergency stop 2 ATRs below. My end of bar stop, a close below this level, a close below 86. Put my trailing stop level 1.5 ATRs above. Look where it closed on Friday, 86.02. Had this closed at 85.99, I simply would have gotten out of the trade. But it did close above 86.02 precisely, so I stayed in the trade. Currently, this trade, I am down 0.45%, and Monday, if we close under 86, I'm out. If it stays above, I stay in. Take profit targets, whatever. But this is my line in the sand. The close below this line, I'm out. The close above, I stay in. But the remaining shares down 0.45%. Okay, I did take a trade on Costco on Friday. Interesting trade. Of course, Costco had earnings, went down 3.91%, but we are into some key levels. So this particular entry, there are 3 rejections, key rejections of why I entered the trade. The first rejection is that we rejected the high of the order block, meaning we were in the order block during the day and we closed above the order block at the end of the day. That's one. The second is that we rejected the 200-day moving average, the black line, deep dip buy signal, okay? The third is that we rejected the negative third ATR channel. So the rejection of the high of the order block is a primary signal. The rejection of the 200-day moving average is a primary signal. And the rejection of the negative third ATR channel is a secondary signal. I would not take a trade just based upon a secondary signal, but if I have primary signals that are valid, the secondary signals add some bonus points to the trade. Okay, so I entered on Friday at 9:56.26. I place my emergency stop 2 ATRs below. My end of bar stop on this trade is simply a close below the 200-day moving average. Today it's 9:55.07. So you can see I'm entering very close to where my stop is. And then of course I have my emergency stop 2 ATRs below as my worst case scenario. So it's a good risk to reward ratio. The reason I entered is because there was 3 rejections of key levels. Doesn't mean it has to bounce right up from here though. It may not. But if it does, great. That's what I'm looking for. But if it closes below that 200-day moving average on Monday, I simply get out. I can wait for another signal to get back in. So break even on this trade, just entered it here at 9:56.26. So we'll see what happens. I have no control over this, but I do know exactly what I'm going to do. If it stays above this 200 and goes up, I'm going to start taking profits. If it gets my trailing stop level, I'll go into trailing stop mode. If it closes even a penny below this 200-day moving average on Monday, I was wrong and I get out. And hopefully, if I'm wrong small. But in the worst case scenario, I have my end of bar, or excuse me, my emergency stop 2 ATRs below there. And even with that, in the worst case scenario, it's only going to happen about 5% of the time, I'm going to lose 1% of my account. So it's all about if-then statements. If this happens, then I'm going to do that. And really, from over 30 years of trading, everybody, I am 100% convinced the best way for the majority of traders to make money in trading is to have a if-then statement process. If this happens, then I do that. If that happens, then I do this. And so it's a structured plan, right? Paint by numbers, trade by numbers. There's no discretion allowed in this. It's systematic. So anyway, new entry 9:56.26 on Costco, and we'll see what happens Monday. Okay, so those are the open trades. Just to do a recap, CCL up 14.97%, Dash up 3.51%, GDX up 3.79%, Silver down 2.22%, Lockheed Martin up 3.47%, RBLX up 9.12%, Gold up 2.03%, Netflix down 0.45%, and Costco break even. And so, in trading, there are 3 allowable situations with your losses. Big wins are fine, obviously. Small wins are fine, obviously. Break-even trades are fine. Small losses are fine. I guess there was 4, not 3. But what's not allowed are large losses. And so you can see with the positions there, not all my positions, not all of them are profitable, but do I have some big gains? I do, definitely. CCL, 100%. Have some big gains. Do I have some medium gains? I do. Most of those are medium gains. Do I have some small gains? Yes. Do I have some small losses? Yes. But what you don't see on there are any large losses. So I'm doing my job correctly if that's the case, and that is the case. So I'm doing my job correctly. Okay, let's go to the closing trades that I had. And earlier on silver, I was telling you about my longer term positions where I have a 2 ATR stop and 4 ATR profit target. So I entered UNG here on the 15th of April at 10:57. So why did I enter here, 10:57? Well, the reason goes all the way back here into beginning of 2026. As with silver, I showed you we had a blue bar and it was an abandoned baby. Well, this is not an abandoned baby, but this is what is called an island reversal. An island reversal and abandoned baby are the exact same concept. It's just an island or abandoned baby always consists of 1 bar. Anything more than 1 bar is an island reversal. So these 3 bars are an island reversal. Why? Well, the day before the green box started, we gapped down. Sentiment is very negative to the downside. Then for a couple days later, we moved sideways and then we gapped way up, leaving these 3 bars by themselves. Not an abandoned baby. Abandoned baby is just 1 bar by themselves. An island reversal is 2 or more bars. Okay, so That is a very bullish signal. Was it bullish? Yeah, for about a week it was very bullish. But the one thing that I know about abandoned babies and that I know about island reversals is when they are formed, and this one's formed, the high of the island reversal or the high of the abandoned baby is a very strong level of support. So the dotted line here is the high of the island reversal. And all I'm waiting for is the price to come back and reject that high. So waited a long time, but that did happen here on the 15th of April when I took the trade. On this day, it rejected the high of that island reversal in the past. And again, when I use island reversals or I use when I use island reversals or abandoned babies, the way that I structure the trade is that I place a 2 ATR stop below and I place a 4 ATR profit target above, and I just let it go. I'm either going to lose 1% of my account or I'm going to make 2% if I'm right, and I just let it go. But the key is with this, I am when I come down and reject the high of an abandoned baby or an island reversal, I am more likely to make 2% than I am to lose 1%. So there's your odds. That is the edge in the system. So I entered here. Sorry, I'm trying to get these. I entered here at 10:57 with a rejection of the high of the island reversal in the past. I placed my basically my emergency stop, my one lose 1% of my account stop, my emergency stop at 974, and then to the upside 2% profit target up here. I entered, I've been up on the trade, down on the trade, and then look what happened on Friday. Actually got taken out, made 2% of my account on this particular trade. And so I'm out of the trade now. It's done. And this trade locked in a gain of 13.5%. Pretty cool, huh? Now, look, I just made 2% on my account. I can take the money from this, invest that money into two more of these, and I could have two losing trades and I'd still be even. So that's the point. Taking money, reinvesting it into a new trade that has a better risk to reward ratio, and that's how you compound money. So really great. Did hit the 2 ATR or the 4 ATR profit target instead of the 2 ATR loss, locked in a gain of 13.5%. And then last but not least is CSGP. I did have to exit this trade for a loss. I entered this trade on the 20th of May at $34. Why? This is called a higher low V1 in the value zone. Really like these trades. The winning percentage on these trades is much higher than the losing percentage, but on this particular trade, did not work. Let me bring your attention to this screen line and this screen line. This is the 1 ATR channel. This is the -1 ATR channel. Anywhere between the 1 ATR channel and the -1 ATR channel is considered the value zone. The setup on this strategy is that first of all, we have to have prices close below the low of the -1 ATR channel, which they did. Second requirement, we have to come up into the value zone, which we did. The third requirement is we have to have a pullback followed by a V1, V2 reversal, which we did. This is bar 1, this is bar 2. Bar 2 goes below bar 1's lows, closes above bar 1's close. That is a V1. So I entered here at $34 even. I placed my emergency stop 2 ATRs below. My end of bar stop is a close below halfway of the number 2 bar on the V1. That is this line right here, 33.26. That's where the inherent support should be. The next day, tried to move up, really couldn't do it. The next day, tried to move up, really couldn't do it. And then this one just didn't work. The very next day, it closed below halfway the washout bar. And so I had to take a loss on the trade of 4.55 So that's why I did exit that trade. So recap on the closed trade, UNG locked in a gain of 13.5%, but CSGP, I did have a loss of 4.55%. So I am out of both of those trades at the moment. So that's it, everybody. Those are the open trades. Those are the closing trades. Hopefully that was helpful for you to kind of see why I entered, how I structured the trade, what I did, how I managed the trade. And so we'll take a look at some new potential entries for next week in a moment. Let's just spend a few minutes on trader psychology first. All right, this trader psychology post comes from my friend Steve Burns. You can follow Steve at @SJosephBurns over on Twitter. Really great author, really great trader. You should check out all of his books on Amazon. He has many, many books. I think he is the second most trading book author there is, and I'm sure by the time he's finished, he will be the number one. And my favorite book of his is the Revised Moving Averages 101. I was fortunate enough to write the foreword on that book. So check them out. They're all on Amazon. So let's see what Steve has to say here. When supply or demand zones align with Fibonacci levels, moving averages, or trend lines, you found confluence. When you have three or more factors agree, or in other words, when you have three or more confluences, you have found institutional decision points. Trade those. All right, you're preaching to the choir, Steve, because that is exactly what I do. I look for confluences. In the trades that I just showed you, what are the confluence point factors? The supply and demand zone factors. Order blocks, trend lines, moving averages, RSI levels, double bottom bullish MACD divergences, which is also something that I use, V1, V2 entry point. So it's important, everybody. That's why I'm so patient with my trades. I mark those trades up, I mark those charts up, and I wait for those trades to reject those key levels because I want to be in sync with institutional decision points. That's why when I take, not all the time I wish, but the majority of the time when I take a trade, they usually bounce. And that's because I am at those institutional decision points. They see them just like I see them, right? I stay away from momentum trades and so forth. I try to be in sync with the institutional decision points because ultimately it's the institutions that are moving prices. So the point here, as far as trading psychology goes, really the point is patience and waiting and waiting and waiting for those confluences to happen. Even when you wait and you have those confluences, it doesn't mean you're going to have a profitable trade, but it does stack the odds in your favor. And really, as traders, that's all we can do. Be patient, wait for those confluences, position size correctly, structure the trade so that if we're wrong, we can be wrong small, which is totally fine. Or if we're right, we can have some outsized gains. All right. So one more time. When supply or demand zones align with Fibonacci levels, moving averages, trend lines, you have found confluence. When three or more factors agree, you have found institutional decision points. Trade those. You know, when I was talking about halfway of V1 or V2 bars, that is a Fibonacci level. That's 50% of the washout bar is a Fibonacci level. So thank you so much, Steve. Appreciate that. And like I said, the takeaway here is being patient and only trading the signals that have these confluences. All right. Okay. All right. Here we go. So I have 8 potential setups for next week. Now, they are not where they need to be yet. If they were, I probably would have already taken the trade, but they are within striking distance of some key levels. In other words, next week, it's possible we could get to those levels and reject. And so at that point, I may take the trade. So I mention this every podcast, but these 8 symbols, it is possible next week that on any particular day, all 8 of these signals could trigger. So does that mean I would go piling into all 8 positions? No, absolutely not. I have a rule I only take one trade per day, regardless of how many valid signals there are. That's it. And so if I have these valid signals, I am going to have to make a decision which one's better. And so how do I do that if they're all valid? Well, there's always going to be one that's better than the other, for sure. And so I give it a scoring system. For example, if it has one trigger, one signal, I give it a score of 1. If it has 2, I give it a 2. If it has 3, I give it a 3, right? And usually I'm going to take the one that has the highest report card, has the highest score. But I also have to look at the risk to reward ratio. Maybe I have something that has 4 entry signals, but the risk to reward ratio is really bad. Okay, I may have to pass on that. I also look at higher time frames. What is the higher time frame telling me about the shorter time frame? And actually on Walmart, I'm going to show you exactly how I do that. I also look at relative strength. If the market's down, but this particular market that triggered is up, it gets an extra bonus point because it was strong in the face of a weak market. All right. And so, you know, this is how I trade. This is what I teach my students. And if I could just take a couple minutes, put in a quick plug for myself. I teach students all over the world. I teach a really good course. I've been teaching this for many, many years. It's a 20-hour one-on-one course where the student and I, we meet 2 hours a week online for 10 weeks. I teach you all the strategies that I use. I teach you all the rules. We do a lot of simulation trading. And I think it's one of the best courses out there. I've turned out so many great traders around the world. I have completely beginning traders come to me. I have hedge fund guys come to me, and everywhere in between. So if you would like to learn to trade like I do, it takes a while. That's why the course is 10 weeks, but I'll teach you everything I know. I'd love to have you as a new student, and it's very important to me that my students succeed, and I try to bring 110% to each lesson. So if you're interested in becoming my student for the 20-hour course, the cost is $2,000, but I know it's a lot of money, but it is an investment in your trading, and I'm sure you'll be happy. And I think it will be worth every single penny. So if you're interested, my email is in the link of this YouTube video. Just send me an email, say, Greg, I'm potentially interested in taking your course. I'll reply and say, hey, Greg, why don't we have a kind of get to know you call? It's not a sales call. I promise you it's not a sales call, everybody. It's just that I want to kind of put a face to the name, understand the student, understand their goals, their trading challenges, and then it's a really good time for them to ask me any questions about the format of the course. But it's not a sales call, so don't worry about that whatsoever. But I'd love to have you as a new student, and so send me an email. Lastly, if you like online courses, I have a really good online course at udemy.com. I have the link in the description. In that course, I teach you step-by-step the deep dip buy trading strategy. It's a great course, sold so many around the world. It's affordable, $30 to $50. It's 9.5 hours of content, so you get a lot for that. So the Udemy course link is in the description. So one-on-one course, just send me an email. The Udemy course, just look for the link. But anyway, thanks for put in my plug, and I would love to hear from you and love to have you become my student. So, all right, let's take a look at the potential trades for next week. All right, so usually I'm talking about green boxes. I'm talking about bullish order blocks. Well, there is also bearish order blocks, and on Boeing, this is a bearish order block. Bearish order blocks are just the reverse of order blocks. So for a bearish order block, we need a swing high, followed by a swing low, followed by a higher swing high, and then a market structure break to the downside. And after that market structure break to the downside, if we rally back to the bearish order block, that's where I want to be looking to short. So this is a potential short trade on Boeing. Now, here's the highest closing bar before market structure to the downside. So this red box is your bearish order block. But as you know, I like to have key levels inside of bearish or bullish order blocks. And it all starts with this big down bar here on the 14th. Huge, big down bar. If I have a big, huge down bar, if I rally back to halfway of that, that's going to be inherent resistance. So really, just to make it simple, what I am looking for on Boeing is if Boeing continues to move up and rejects 235.60, meaning it went above it and closed below it, or touched it and closed below it, that's a rejection of 235.60. I would enter a short position there. I place my emergency stop 2 ATRs above, as always, and my end of bar stop is simply going to be a close back above 235.60. So I don't know if Boeing's going to get there. I don't know if it's going to reject. I mark these trades up and I look at it like, ideally, this is exactly what I want to happen. And if it happens, then I consider taking the trade. If it doesn't, I just leave it alone and I look to trade another market. But for potential short for next week, again, I am looking for a rejection of 235.60. If it closes back above 235.60, I'm out. If it continues to close below, I will stay in the short, take partial profits to the downside if it moves my way. If it gets to trailing stop load, then I'll go into trailing stop mode, but on the short side. But that's what I'm looking for next week, a rejection of 235.60 for a short. Berkshire Hathaway. All right. Well, Berkshire Hathaway, you can see we have a very large green order block to the downside here. Now, it rejected the high of the order block on Friday. Does that mean I take the trade? No, because where would my stop be? A close below the low of the order block. That's a long ways down there. All right. So I need to find a level inside. It's a horrible risk reward ratio. So I need to find a level inside the order block. Well, here it is. Here's a V2, bar 1, bar 2, bar 3. Bar 2 goes under, bar 1's low, bar 3 closes above bar 1's close. That's a V2. Where is the support level? Yeah. Well, it's halfway of the V2 of the number 2 bar of the V2 right here. And so roughly 467. That's going to be in some inherent Fibonacci level. So I don't know if Berkshire is going to get down here or not, but if it does, I will consider getting long if it rejects 467. If it does, I'll consider entering the trade. My stop will be a close back below 467. Walt Disney, this one got kind of close. I talked about this last week. We have an order block over here, swing low, swing high, lower swing low, market structure change. The market structure change defines the order block, high and the low of the lowest closing bar prior to market structure change, bring it into the future. And look, there's a nice moving average inside that order block that I can key off of. That is the 50-day moving average. The 50-day moving average is 101.62. Right now, we are 101.86. So we did not reject it, but if Disney goes down at all on Monday, we very well could reject it or go below it. But the key is if we go below it and then close back above it, that would be the entry. A rejection of, at the moment, 101.62. If it rejects it, close back above, I would consider getting long Disney. But of course, my end of our stop would be a close back below that 50, giving me a very good starting risk to reward ratio. So, yep, looking for a rejection of the 50-day moving average. At the moment, it's 101.62. It will change on Monday, but just looking for some kind of bounce or intraday rejection, or even a close under, close back over. ET, Energy Transfer, kind of similar to Disney in a way because we have an order block here and we have a moving average inside the order block. That's the gray line. Well, on Friday, we closed underneath it. Had this gone underneath it and closed back above it on Friday, I would consider getting in the trade, but this did close below, so it did not reject. However, next week, if we close above the 50-day moving average, and right now it's 119.22, I would consider getting in, and then I would use a close back below the 50 as my end of bar stop. All right. So if we reject the 50-day moving average next week, depending, I mean, maybe it rejects it, but it goes way up here. Well, I'm not going to buy that because now the risk to reward is bad. The starting risk to reward is not good. So I would pass on the trade. But if we get kind of a nice gentle close back above the 50, rejection above the 50, then I would certainly consider taking it, and my stop would be a close back below the 50 going forward. NVIDIA. All right, so NVIDIA has not really, it's been kind of weak, has had relative weakness compared to the rest of the market. We do have a nice order block here, and we do have a 50-day moving average inside the order block. Wow, most of these trades have to do with order blocks and 50s, which just means they're higher order blocks. But, you know, I don't know. 100% I don't know, but it is certainly possible if the market turns down a little next week that we could get a rejection of that 50-day moving average. And the important part is that 50-day moving average is inside that order block. That's the key. So the NVIDIA at the moment is 199. Excuse me. The 50-day moving average inside the order block is 199.35. We're at 211.25. So we'd have to come down about 12 bucks or so, but it's certainly possible. You never know what happens, but that's the key level that I'm looking for, a rejection of the 50-day moving average next week. And then my stop, if it does reject it, my stop would be a close back below the 50-day moving average. WES, Western Midstream, had a huge run up. Now it's coming back down, obviously due to oil prices. And we have 3 potential levels inside this order block. Again, with the 50, right? The 50's the closest. The 50 is at 42.07 at the moment. Rejection of the 50, I could consider that. I also put in my own level at 41.69. Why? Well, let's go in the past. It has to do with the past. Here's a V2. Bar 1, bar 2, bar 3. 2 goes under bar 1's low. 3 closes above bar 1's close. Where's the key support level? Halfway the washout bar. That's 41.69. So I brought that into the future. So either a rejection of the 50-day moving average, which is now 42.07, rejection of 41.69, which is my key level. And look, we have a 100-day moving average down here as well. The 100 at the moment is 41.10. So there's 3 key levels that I could look for a rejection. Yeah, I'd like the 100, it's lower, but I would certainly consider the 50. And then also we have the bottom of the order block. The bottom of the order block is very close to that 100, but the bottom of the order block would also be legitimate, and the low of the order block is 40.86. So either a rejection of the 50-day moving average, a rejection of my key level 41.69, a rejection of the 100, which right now is 41.10, or a rejection of the low of the order block, which is 40.86. Walmart. All right, Walmart was legitimate on Friday. I took Costco instead because it had a higher quality score. But look, we did reject the 100-day moving average. We did reject the bottom of the order block for sure. So what do I do from here? So look, the RSI is at 28.96, so it's under the 30 RSI. If we were to close above the 30 RSI, that would be legitimate for sure. I don't love it because this big down bar on Friday, and the closer we get to halfway of that big down bar, the more resistance we're going to have. So look, Walmart, you know, has really sold off, and we are coming to some key levels. So I really do want to watch this one closely. Maybe if we get a retest of the 200 on Monday, I would consider that. But really the key level here on Walmart, I believe, is the bottom of this lower order block. And I put a level in here at 111.70. Why did I pick 111.70? Well, earlier I was telling you about looking at higher time frames. So if we go to a higher time frame, this is the weekly. Do you see the 50-week moving average? Well, that 50-week moving average is going to obviously be an important key level at 111.17. So what I did was I put the 111.70 level onto the weekly level onto the daily charts. And that daily chart, or that 111.70 weekly level, dovetails right with the bottom of that lower order block. So there's a lot of different ways to approach Walmart at this point. like I said, even Friday was a legitimate level. It rejected the bottom of the order block and rejected the 200-day moving average. But I liked Costco better, mainly because Costco rejected the negative third ATR channel. And at the moment, we're below the third ATR channel. So going forward, close above the 30 RSI. Okay, fine. Another test and rejection of the 200, fine. But my gut and experience is telling me if it heads down a rejection 111.70, and it's not just a guess, it's the 50-week moving average would be a good level. So all sorts of different potential levels on Walmart. And then last but not least is XLU. I talked about XLU for the last couple weeks. We are inside an order block. Look, swing low, swing high, lower swing low, market structure change. Now we've had a pullback. I was looking for a rejection of the 200-day moving average. Got kind of close on Friday, but we closed under the 200. So that 200 is still above us as resistance. Now, Monday, if we close back above that 200, could I take the trade? 100%. That would be a close under, close over the 200. That would be a deep dip buy strategy. And deep dip buy strategy dovetailing with an order block, key level within key level. If we continue down the 250-day moving average, see the purple line that's poking its head, just barely living inside the bottom of that order block, that would be a really good level too. So essentially XLU has to go up and close above the 200. 200 right now is 44.45, or go lower and reject the 250-day moving average, which is 43.85. So that's what I have there, everybody. Those are the 8 potential setups that I'm looking for next week. If you found that helpful, really appreciate if you hit the thumbs up button. I appreciate you being here. If you made it all the way through, thank you. I hope you found it valuable and helpful. I hope you have a good rest of the week. I always like to leave off with, listen, if you have an opportunity to do an act of kindness for another human being today or this week or every day, do it. I mean, the world really, we could use it. I have this little platform, but I like to at least try to say something positive and use the platform a little bit. But if you can do an act of kindness for another human being, if you have the opportunity, do it. They'll be glad that you did it. They'll be appreciative. Be good for you. I'm also a big animal lover. If you have the opportunity to do an act of kindness for an animal, do it. They appreciate acts of kindness just like we do. And I think the world could use a lot more of that. So why not? Let it start with us and do something nice if we have the opportunity to do it. So really appreciate you being here, everybody. I hope you enjoy the rest of your weekend. If you have any comments or questions about anything I discussed in the podcast, please put them in the comments section. I'll do my best to get back to you. But really appreciate you making it through. And God willing, I will see you next week. So thanks a lot, everybody. Take care, and we'll talk to you later. Bye-bye.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.